Good morning, everyone. This is Sakis Paraskevov, Senior Fundamental Analyst at IronFX Global, bringing you the morning comment for the 21st of December. Spanish elections end in a hacked parliament. Spain's ruling Popular Party lost its parliamentary majority on Sunday in an election that saw the two main political parties losing significant ground to two upstarts, the center anti-corruption party Ciudadanos and the left-wing anti-austerity party Podemos. Having fallen short of reaching the 176 seats needed to win a majority, the Popular Party will now need support from other parties to form a government. Due to political differences among the parties, expectations are for the negotiations to form a coalition government to drag on for weeks. This political instability could hurt Spain's fiscal recovery, as fragmented parliament could lead to an unstable government or one that is influenced by Podemos, resulting in a possible halt of structural reforms or even the reversal of some of them. The increased likelihood of positive structural reforms following the elections could undermine the sustainability of Spain's debt. Even though there was no major reaction from euro, the common currency could experience some selling pressure over the coming weeks if the political leaders fail to reach an agreement. As for today and the rest of the week, we have a relatively light calendar with no major events on the agenda. The market liquidity is likely to remain thin during the holiday season. As a result, prices can move sharply or not very much at all. Today, Eurozone's preliminary consumer confidence index for December is expected to have decreased. From Sweden, we get the economic tendency survey for December, but no forecast is available. As for the rest of the week, on Tuesday, the US final estimate of Q3 GDP is expected to confirm the second estimate and show that the US economy expanded at a 2.1% quarter-on-quarter seasonally adjusted annualized rate. Even though this is the final estimate and usually not a major market mover, following the Fed's first rate hike in almost a decade, it could support the Fed's view that the US economic activity is expanding, albeit at a moderate pace. Despite this data being outdated, it could help to solidify the improving outlook and may add to dollar gains. The third estimate of the core personal consumption index, the Fed's favorite inflation measure, is forecast to have remained unchanged. On Wednesday, we get the US durable goods orders as well as personal income and personal spending, all for November. The durable goods figure is expected to have fallen, a turnaround from the month before, while durable goods excluding transportation equipment are forecast to have decelerated somewhat. The focus is usually on the core figure, where a possible slowdown could cause the dollar to give back some of its gains following the GDP data on Tuesday. Personal income is expected to have slowed down, whereas personal spending is forecast to have accelerated. While the expectations are mixed, an improvement in consumption, which accounts for approximately 2/3 of the US GDP, could offset the slowdown in consumer income. A possible explanation for this discrepancy between the two figures could be the plunge in oil prices. As oil becomes cheaper, consumers have more disposable income to spend, which could increase overall demand. As such, an improvement in consumption during the year's final quarter could prove positive for the US dollar. Net-net, the main focus could be on personal spending due to the Fed's emphasis on inflationary signs. On Thursday, we have a relatively light calendar day with no major indicators or events on the agenda. And finally, on Friday, we have the usual end-of-month data done from Japan. The national CPI rate, excluding food, is expected to have escaped the negative territory, but to have remained flat, while no forecast is currently available for the headline figure. Despite the expected improvement being minor, if the forecast is met, it would support the Bank of Japan officials' view that the underlying trend of inflation is improving. Following the bank's announcement on Friday to launch additional measures to stimulate wage growth and inflation, an improvement in the nation's inflation rate, along with a thin market, could give the bears another reason to push USD lower. For more information, including technical analysis, please read the full comment on IronFX.com or download our app and get all the information you need to trade delivered directly to you. And also, follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google Plus to get more trading ideas. This is Sakis Paraskevov, Senior Fundamental Analyst at IronFX Global, wishing you solid trading.